Thank you for joining us at xam.com. I'm Christina Marujas. With me today is our lead investment analyst, Rafi Boyadjian, and we'll be looking at the week ahead. Rafi, GDP numbers out of China will be eyed as investors are eager to know whether the world's second largest economy is recovering after moderate weakness in 2023. What are we likely to see in the data?
Well, Christina, for sure, China has been in the headlines a lot of question marks about the strength of its recovery. Of course, we've got that property market crisis, which is still ongoing. We're still hearing, reports of big developers defaulting on their loans. We're also seeing the shadow banking coming under pressure. Of course, overall, exports have been underperforming as well in 2023 because, of course, those ongoing trade frictions with the US. However, we have been seeing a bit of a rebound in consumer spending as well as industrial production in the last few months of 2023. So this could be down to the various support measures the government has been announcing over time. So the government appears to have resorted to drip-feed stimulus as opposed to one big stimulus package. That's, of course, has left investors very disappointed, but potentially they may be now starting to have some effect. So possibly we may see a bit of a rebound in annual GDP growth from 4.9 to perhaps 5.2, 5.3%. The question is, of course, how much of a boost would this be for the markets? Would it convince the markets that China's economy is now, at least the recovery, is back on track?
One could say that inflation is likely to be a main theme of the upcoming week. Yesterday, US CPI came in stronger than expected. Do you think we could see equally strong reports from the UK, Canada, and Japan this upcoming week?
So clearly the CPI numbers from the US they do provide a bit of an upside risk for the incoming data from other countries. You mentioned the UK, Japan, and Canada. So the UK, of course, inflation has taken a lot longer to come down. And so we may actually see perhaps even a slight drop in UK CPI in December, or perhaps it might stay unchanged. We are seeing, of course, increased competition among UK retailers, which is putting downside pressure on prices. But on the other hand, we still have UK services inflation being rather high. Overall, the UK inflation is expected to continue to come down sharply in the coming months, even if, say, December, we see a bit of a stalling in the progress there. But the question mark, the big question for the markets is, is stronger inflation data really going to convince them that central banks will keep interest rates higher for longer? Because they seem hell-bent on, pricing in steep, aggressive rate cuts. Potentially, though, we may still see a bit of a boost for sterling if there is an upside surprise in UK CPI. In Japan, however, we are seeing inflation moderate. And even if we see a slight pickup in, say, December or January, I think overall it's unlikely that in 2024 we're going to see much of a re-acceleration in Japanese inflation. The key there now is for Japanese CPI to remain above the Bank of Japan's 2% target. I think in the bigger picture, markets are now pretty certain that the Bank of Japan won't be announcing any policy shift at the January meeting, or probably not even in March either. So April is really going to be the focus for the Bank of Japan because it's going to come after the spring wage negotiations. So the yen will probably not move much on the data. Now, moving on to the Canadian CPI numbers. Now, we had seen, of course, Canadian inflation fall quite significantly earlier in 2023. It had fallen to below 3% at the beginning of the summer, but since then it had started to edge up. Nevertheless, markets are still anticipating steep rate cuts from the Bank of Canada. Now, even if we see a slight uptick in December, it's unlikely that those expectations will change radically. It also has to be said that the Canadian dollar has been tracking, what's been happening to broader market sentiment. But for January as a whole, the Canadian dollar has fallen back a bit against the US dollar. So perhaps stronger than expected CPI numbers might help the loonie recoup some of its year-to-date losses against the greenback.
And finally, let's cross into the United States. Rafi, markets are pricing in heavy rate cuts by the Fed this year, currently standing at around 150 basis points. Could Wednesday's retail sales report make investors readjust those expectations?
Well, potentially, yes, Christina, we could see stronger than expected retail sales numbers boost the US dollar as a result of sort of a lift to treasury yields. But we didn't really get that from the stronger than expected CPI numbers. Okay, maybe two stronger than expected reports back to back might just do the trick in terms of investors scaling back their sort of aggressive rate cut expectations for the Fed. But overall, probably investors will be maybe paying more attention to signals from Fed policymakers rather than the data. So potentially, obviously, we have some other data coming up as well as the retail sales numbers. So overall, if it's a good week for US data, we could see those rate cut bets being pared back and the dollar appreciating. Overall, though, markets are pretty much sticking to their sort of expectation that the Fed will soon begin cutting rates. So really what's changed in the last few weeks is the fact that rate cut expectations have shifted somewhat from March to May.
Rafi, thanks so much. This was the week ahead here at XM.com.